What if I told you that one of the biggest stories in crypto right now isn't about price, but about who may have been quietly pulling the strings behind the curtain? Lately, everyone has been throwing shade at Jane Street, painting them as the mastermind behind months of strange market behavior. But here's the strange part. The moment legal pressure started building, the chart suddenly turned green. Coincidence? Or something more? Welcome back to Reverse Crypto, where we break down what's really happening beneath the surface of the crypto market. If you want daily insights that cut through the noise and keep you ahead of the herd, make sure you hit that subscribe button and smash the like button right now. It helps the channel more than you know. Today, the entire crypto space feels different. Bitcoin pushed higher. Ethereum woke up. Solana caught momentum. XRP showed strength. Litecoin started moving. Sui gained traction. Polkadot quietly built pressure all week and then popped. It wasn't just one coin. It was broad market strength. And that's where the rumors started spreading fast. Many traders believe that certain large quantitative firms may have been suppressing price action for months. The idea circulating across crypto Twitter is that coordinated algorithmic selling, especially around predictable times, may have repeatedly knocked down rallies before they could gain traction. Some even point to consistent morning sell-offs that seemed too mechanical to be natural market flow. Then came the lawsuit. Jane Street was reportedly sued over involvement related to the collapse of Terra USD and Luna back in 2022. Allegations surfaced claiming automated strategies were aggressively dumping Bitcoin daily at a fixed time, triggering liquidations, shaking out retail traders, then accumulating lower. According to some market watchers, those suspicious sell-offs stopped immediately after legal action hit the headlines. Now Bitcoin is back near $70,000, and people are asking hard questions. How much of the previous downside was organic fear? How much was mechanical pressure? How many traders panic sold because the charts looked broken? How many were liquidated using leverage? Let me say this clearly. Everything circulating right now remains allegations. Nothing has been proven in court. There is no official confirmation that coordinated suppression occurred. But the timing has raised eyebrows across the industry. Then things got even stranger. An account allegedly linked to Jane Street appeared to have wiped its social media history clean. Screenshots circulated, claims went viral. Some insisted this was evidence of damage control. Others countered that the firm never operated an official X account to begin with. Industry voices pushed back, saying the viral narrative may have been exaggerated or entirely fabricated. So what's true? Right now we're in speculation territory. No hard proof, no official admissions. Just a market that suddenly looks stronger the moment scrutiny increases. Meanwhile, something significant happened in Washington, D.C. Lawmakers held meetings focused on the Clarity Act, stablecoins, digital asset taxation, regulatory structure. Senate Democrats gathered to discuss framework details. Republican senators met with major crypto voices including Mark Andreessen and Chris Dixon to explore legislative direction. Discussions also touched on artificial intelligence and maintaining U.S. leadership in emerging technologies. There's a March 1st White House deadline approaching for regulatory clarity proposals. That matters, because while rumors swirl about trading desks, the real long-term driver of this market isn't drama. It's regulation. The Blockchain Association released digital asset tax principles aimed at modernizing crypto taxation. These proposals include small transaction exemptions, treating stablecoins like cash for tax purposes, updated staking and mining reward guidelines, and clearer reporting standards. Industry leaders are actively briefing congressional staffers, walking them through how tax rules should be structured to support innovation instead of crushing it. If Congress gets crypto taxation wrong, it could suffocate growth. If they get it right, it unlocks massive institutional adoption. At the same time, consolidation during downturns continues to tell a story. Over 400,000 Bitcoin were accumulated between $60,000 and $70,000 during the recent pullback. That suggests high-conviction buyers are absorbing supply while weaker hands exit. Bear markets redistribute ownership. Strong hands accumulate, weak hands capitulate. And while traders argue on social media, the infrastructure keeps advancing. Stellar executives recently described the current moment as crypto's iPhone moment, a convergence of AI, embedded finance, and blockchain tools that dramatically lowers the barrier to building new financial applications. MoneyGram's CEO discussed how legacy remittance giants are adapting to digital assets. Traditional firms are realizing blockchain can slash costs and accelerate cross-border transfers. Tokenization is expanding beyond stablecoins. We're seeing tokenized money market funds, private credit funds from Apollo and Janus Henderson, and increased interest from asset managers exploring blockchain at the origination level of loans and structured products. Securitize is building across multiple chains. Institutions are experimenting. Capital markets are testing on-chain issuance. This isn't speculation anymore. It's integration. So where does that leave us? We have market manipulation allegations. We have regulatory negotiations accelerating. We have tax reform discussions underway. We have tokenization expanding. We have institutional voices pushing forward. And we have price strength returning at the same time legal scrutiny increases. Is the rumor true? Was suppression real? Or are we witnessing natural cycle behavior amplified by social media narratives? Nobody knows with certainty. But here's what is clear. When regulation firms up and institutional frameworks stabilize, the ceiling for crypto expands dramatically. The technology underneath Bitcoin, XRP, Ethereum, and the broader ecosystem hasn't weakened. It continues evolving. The biggest question isn't what happened yesterday. It's what happens when regulatory clarity meets institutional demand. That's the intersection that could define the next phase of this market. If pressure from questionable actors truly eases and lawmakers deliver workable rules, the recovery could accelerate faster than most expect. We're watching history unfold in real time. If you found value in this breakdown, make sure you subscribe to Reverse Crypto, hit the like button, and drop your thoughts in the comments. Was this market being artificially pressured? Or are we just seeing cycle dynamics play out? Either way, things are heating up, and we're just getting started.